I had a dream last night that the market's going to go down. Should I liquidate my accounts?
The Wealth Advocates simplify the financial world and show you how today's events could affect your financial health so you feel confident about your financial future.
Good afternoon, Wealth Advocates Nation. It's great to be back here today. I'm here with John Mickelson. I'm Patrick Jenkins. We're going to talk about market volatility. What an exciting topic.
Yeah.
John, market volatility, is this new? Is this something we shouldn't expect?
Sort of. I think that we have periods where things are relatively calm and times when they get a little more crazy. And I think we're heading into a period, especially with the political environment, geopolitical problems that exist. I think you'll see a lot more up and down and a lot more volatility just because of those things. But which a lot of that is driven by emotion and not real numbers as well.
You know, you bring up a great point. This is when there's volatility in the market, we see that convergence of business facts and investor emotion just so acutely. We see what an emotional topic money really is. Any thoughts on that?
Yeah. I mean, in some ways, I tell people that the markets are going to move based on real numbers. And what I mean by that is, you know, someone will come up with something. I'm speculating that the interest rates are going to go higher or lower, and we don't really know where they're going to go. But we move based on those assumptions. And so the market moves up or the market moves down. And then real numbers come out and it equilibrates back to where it's supposed to be. However, there is an emotional aspect to this, and that is, you know, if people think it's bad, it becomes bad. We can become a self-fulfilling prophecy because if we think it's going to be bad, we pull back. We say, hey, I'm going to hoard my money. I'm not going to invest. I need to play it safe. If enough people do that, it creates a movement. And so emotion really does have a lot more to do with the markets than people probably give it credit. And that's one thing where I think, you know, all the algorithms and speculation, all the things that the people put out can't account for human behavior. And that's one of the hardest things about what we do.
You know, there's an interesting phenomena in investor mindset and emotion. If we could just look at a 10-year period, a 5-year period, even a 3-year period, most investors would say, oh, the market goes up. The market goes up a lot. And then you hit on something that's very interesting. Emotion does drive these small periods of time. So we saw that period of time from August 1 to November 1 of 2023. The market falls 22%. And it causes a lot of emotion because we just come off of a period during 2022 when the market went down because of COVID. But small period of time, the market suddenly resurged from November 1 to end of year and made up for that loss. So you have small periods of decline or volatility, if you will, and then you have longer periods of growth. If you look at 2020, 2015, say, all the way until present, the market's just gone up. It's gone up almost 64%. It looks like it's a money-making machine. Any thoughts or feedback on short-term versus long-term horizons?
You know, you really do have to realize, I mean, even if we take the period of COVID, I mean, the market dropped and everyone knew the whole world was shutting down.
Yeah.
But the market dropped and then it shot right back up. Well, what happened? We pumped out all that money and it stimulated the economy. No one thinks about how bad it got. I mean, because if you look back to it, it's this little teeny sliver in the timeline of that year. Forgive me for using a sports analogy.
Good, go.
Okay, so here's my sports. Getting short-sighted is dangerous. And my analogy is one of my favorite all-time champions is Roger Federer. Now, many of you probably don't know tennis and don't know him, but he won 70% of his matches, nearly 70% over his whole career, long career. Now, if he won 70% of his matches, individual points that he won, guess what percentage of the individual points, when you add them all up for his whole career? 52%. He only had 2% more than the other guy, which the analogy and the point I'm trying to make is we get so caught up in the swings of the moment, we don't realize it only takes that small margin and longer perspective to make us a champion. And so I think it's really important to make sure that, you know, people understand, especially those that work with us, understand our role is to try to make sure we're looking for the blind spots, to make sure we're moving toward the opportunities when everybody else is in the streets crying. We want to take advantage of those things.
I think in this vein, before we really dive into the historical elements of it, let's get some definitions on the table so people can understand the terminology we'll use as we talk about this. The first is a dip. A dip is a small period of time. It's really not defined by any time, but it's not very long. It goes down and comes back up. That's a dip. A correction. A correction could be more than 10% off the highs,
Yeah.
right? How about a bear market? We're getting into really economically defined definitions here, economically defined terms here. And a bear market is where the market declines more than 20% off its recent high. That's where we'll hit bear markets. We don't, you know what? In our lifetime, we've only seen 3 bear markets.
I know. Yeah.
That's surprising.
Yeah.
That's surprising.
And they don't last long.
No,
I mean, that's,
they typically don't.
Yeah.
But a recession, what is a recession?
Yeah.
Go ahead.
It's just a slowdown. I mean, that's the thing. I think people can define it a lot of different ways.
Well,
but
this one has
2 consecutive quarters, right?
It's that. And we saw in 2022, politicians tried to redefine what a recession.
They didn't want to say the word, so let's redefine it.
No, but most economists agree that it's 2 consecutive quarters of a pullback.
Yeah.
And then a crash. You don't see those frequently.
No.
1929 is the crash, but there's been a few of them. The best example of one in my investing career happened in 2012. And we'd been dealing with 2008, 9, and 10. And somebody fat fingered a quote so big that in a 2-minute period, the market went straight down to almost like zero and then back up because they undid the transfer. So that is a crash. It's a short period of time. The market goes way down and one hopes it stays up over the longer period of time. It has a quick recovery. It's a short crash, but 29 was a crash that was not short. It all went all the way to 46. So we recovered because of World War II, got into recovery, but didn't get in a full trajectory of recovery until 46. So that's a crash.
Yeah.
So what do you tell people? How do you keep their perspective long? What should we contemplate to keep our eye on the ball and not get rattled by the downs of the market?
Yeah. The starting point with anyone, I think, is starting out with what is it you want?
Yeah.
In other words, my clients have heard me ask this 100 times. 3 years from today, we're sitting down and you're saying, John, that was an amazing 3 years. And I'm not just talking about your money. I'm talking about your life. What does that look like? What would make you say those things? So if people give me answers to those questions, I know what to do. I know what to do with volatility. I know what to do with timing. The reason why I say that is because if things are relatively short term, if someone says, I just want to get out of debt, or if I just want to help with my kids' education, and they're in right now. Those are different from things that are out of ways. If people say to me, I just want to have my retirement on track. I don't know if I'm on track. That's a very common one. Those are very different scenarios. And you have your short, your long, and your medium. If you can define what those things are, once I know your objectives, it helps me decide, okay, what kind of investing plan do we have? If it's longer term, those fluctuations we see, not a problem. If it's, I need the money next year, yeah, we can't afford to have that kind of, we can't have it drop 20% and then say, I need the money. So it changes the way you adapt to the circumstances that we don't know.
Do you have recommended timelines on what long-term money is for clients, what short-term money is for clients, and where you house them?
Yeah, I mean, they're somewhat loose because I want it to be defined by the people I'm sitting with. But your short-term is, I can't have any fluctuation. That's your bank money. That's make sure you get at least a little bit of interest. Don't let it sit idle, even in checking. Don't let it sit idle, earning nothing.
So we're looking at a money market account.
Yeah, money markets.
It's a little bit longer, maybe a CD, right?
Yeah. And then you move to the intermediate. And even in the intermediate, you're going to have a block of very safe money that's there to replenish just in case, what if the car breaks down, the Christmas rolls around, you go on vacation. You need something that can replenish that money if income won't. So in that medium range, that's anything to me from, a year to 10. I mean, it can be longer than that even. It depends on your age and what your objectives really are. But the longer term is going to be, hey, I need the goose that's going to lay the golden eggs forever. And that's some of that money will sit there for the next 15 to 20 years. And so that can have a little more of the up and the down, knowing that we know historically there's so much evidence that shows more aggressive, more return. That doesn't mean I'm going to feel good when it's down 15 or 20%. So we have to always take into account how much comfort is there in those swings up and down. and making sure we're adapting to each person individually.
Okay, really great. Any final takeaways as we wrap this up?
No, the biggest thing is to be confident about what we're going to. Be confident in, when we're looking at a plan and doing what we're doing, we know there will be fluctuations if we want a superior risk to just interest rates. So knowing that, if you can get that confidence when the downs come and you expect them, you can take advantage of it. Instead of being in fear, being in confidence makes a big difference.
Right. Okay, so always look for an opportunity to make money.
Always be opportunistic.
Understand your horizon. So the clients need to segment their money into now money, soon money, which might be 0 to 2 years, and later money, which might be beyond 5 years. If they focus more aggressively on the longer term money, and know that they have adequate funds in the now money, in the short
play defense first.
Then they can have a longer term horizon.
Yeah, exactly.
And just understand, for the long term, the market operates on business principles. In the short term, it may operate off emotions.
Correct. Yep.
Last question for you, John. Can you time the market?
No.
Okay. And that's us with
and no one can.
Have a great day.
Wealth Advocates is an SEC-registered investment advisor. SEC registration does not constitute an endorsement of Wealth Advocates by the SEC, nor does it indicate that Wealth Advocates has attained a particular level of skill or ability. This material prepared by Wealth Advocates is for informational purposes only. It is not intended to serve as a substitute for personalized investment advice or as a recommendation or solicitation of any particular security, strategy, or investment product. Opinions expressed by Wealth Advocates are based on economic or market conditions at the time this material was written. Facts presented have been obtained by sources believed to be reliable. Wealth Advocates, however, cannot guarantee the accuracy or completeness of such information, and certain information presented here may have been condensed or summarized from its original source. Wealth Advocates does not provide tax or legal advice, and nothing contained in these materials should be taken as tax or legal advice. Please consult with your tax professional regarding your particular situation before implementing any strategies discussed. Advisory services are only offered to clients or prospective clients where Strategic Advocates and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Strategic Advocates unless a client service agreement is in place. Strategic Advocates LLC is a registered investment advisor. Please visit our websites at www.wealth-advocates.com or www.strati.co for important disclosures. Securities offered through registered representatives of Creative One Securities, a broker/dealer, member FINRA/SIPC. Advisory services offered through Strategic Advocates LLC, a registered investment advisor. Strategic Advocates LLC, Wealth Advocates, and Creative One Securities are separate entities. Wealth Advocates is located at 255 South Main Street, Suite 140, Logan, Utah, 84321.